Hey, well, finally I've gotten a chance to actually do this. I've been wanting to do this for a while. Simply, a lot of people have a misunderstanding of the long wave model. And I've articulated this is not a trading account. We're not here to be moving in and out of investments every single day, every single week. We want to minimize cost, fees, buying and selling, and participate in a full bull market and step back from bear market in simplicity. So at most, this model is going to change 4 times a year. I've back tested this for 100 years. So don't think that it'll be trading back and forth because it's going to eat into your profits, right? So we're trying to keep the cost down, and we're just want to participate on 80% of the upswing in the market and avoiding the substantial losses. That's extremely important. And to educate people who don't understand exactly what the model and the benefits for subscribers, what they're actually getting. Okay. Now, the most important aspect regarding the model is the theory. I mean, a lot of people know that my focus is on the economic long wave, and as I said, I accidentally fell into this from managing capital for 23 years for wealthy individuals and families, and it just was fascinating to me to understand how the economy works. Not that I was interested in economics, I'm more interested in how things work. So in simplicity, you don't have to understand this, but this is basically the model and what we're looking at in terms of a downturn. We have 3 important cycles turning down. The long wave, which is this generational or lifespan. And this cycle actually peaked in the 70s and it's set to bottom in the 2030s. That's what you see, 1970s and 2030s. The 2022, 2024 is the Kuznets or the real estate cycle. Looks like it did peak last year. I have 2 demographic models. And 2022 is the business cycle. So this is the most important aspect of what's driving the asset allocation model, right? Because that's all it is. It's a model. It's not a product of buying these bonds or these stocks, whatever. It's a model where to allocate. It's really, I designed it for myself, and really it's designed for baby boomers, but I think everybody will be attracted to it because you're just avoiding losses. I mean, markets have corrected 50 to 90% in the past, and to think that won't happen again is ludicrous, especially if markets get overvalued. And in this case, we know real estate is in that territory, and it's leveraged. So just avoid the losses. And probably a lot of people know about Ray Dalio, and the reason is because he made capital for a return for his clients in 2008. A lot of people don't know Martin Pring, which I've modeled, the old model for Canada. Okay, so we know that it's turning down, and one of the things I just measure is where are we in the business cycle. So it's not contracting, as you can see. This is updated for May. I should have June's data pretty soon, and people are getting anxious. And we're seeing that now with the real estate market. So you can see, the business cycle is definitely turning down. The sentiment is still strong. People are still bullish. But again, as you can see, there'll be a time to enter the market. I mean, those who subscribe know we have a very high cash position. And that's simply from building a model, but from my earliest mentors were Templeton, Brandeis, and Peter Kundal, which when I started in the business, that was a long time ago, they used to have high cash positions because they were managing wealth. That's the primary thing, not being diversified, which I think is absolutely ridiculous. I mean, if something is overvalued, why would you want to own it? I mean, say, okay, own real estate because, I'm diversified. But if it's extremely overvalued, why would you want to own real estate or stocks or bonds in this case? So I don't buy into that philosophy. If anything, history has proven it's very dangerous. Now, this is from Martin Pring's model, where we are in the cycle. And obviously, we're in stage 6 here, where commodities have turned down. The economy is still growing. We're not in a recession, but we're getting pretty close. So obviously, it's going to dictate where the asset allocation is in the model, right? We're not here to guess. If we're contracting and we don't know how deep it's going to be, then we know the profits are going to collapse and share prices are going to collapse. And from managing capital for 23 years, people don't like to lose money. No matter what anybody says, oh yeah, I'm bullish long term and buy and hold. Well, baloney. As soon as they have substantial losses, more than 20%, it upsets them, and they know it's going to take a huge 2-3 years of return to get back to normal. So I don't buy into this buy and hold. I mean, people have used Warren Buffett. Well, how much cash does he have today? 130 billion? What does that tell you? Now, to confirm, I just can't guess. Are we definitely in a slowdown? Well, this is simply a business oscillator. So you can see what I see, that the economy bottomed in April 2020. And it's just a measurement of the GDP. If you understand oscillations and energy, and as you can see, there's a cycle there. We're definitely in a downturn, and that's based on the GDP for the month of April. You can see it's in the red. The recession, really, if it has to fall, I have that horizontal orange line. If you look at the GDP month to month, you can see that it's been slowing. In spite of that massive amount of indebtedness by governments and the real estate peak on the first quarter of last year, you can see that we're slowing dramatically here. And again, if we're going into a slowdown, earnings are going to be impacted, share prices are going to be impacted, as we've seen. So obviously, we're staying back and we're holding cash. We can deploy that very large cash position so we can buy low and sell high. That is it. Okay. So, and this is a satellite view. This is what I love about the long wave, right? It's a satellite view. We can see what's coming instead of kind of guessing, because most people and models just extrapolate. And that's why people get into trouble. And I think that's going to be the case for real estate investors, right? They just extrapolate the trend. They say, hey, things are booming. It's only going to get better, and don't realize that everything is cyclical, even real estate. So obviously there's a downturn, and we don't want to risk the portfolio. It just makes sense. Now, if we look at the largest economy in the world, you can see that the data, this is my favorite lead indicator. I just put an oscillator on it so it smooths out the noise. And you can see that we're in a growth recession, but it's not a recession yet, technically. I believe that's coming at the earliest, the end of this year or next year. I've said 2024 is when the hard landing arrives. So again, not a time, when we see that actually turning up, that will be an actual great time to be deploying capital. Does that make sense, right? We're buying low and selling high. We're not holding on to the markets and praying they won't collapse. If they're contracting, raise cash. Once it's cheap and the market will bottom, even the Great Depression, it did bottom, took 3 years. That was the time to buy. And how many people actually did, right? How many people were buying 1929 and hand over fist? And again, it's just avoiding any of those type of losses. So now, this is something very significant, because if you haven't looked at real estate globally for the last decade, and really since about 2008, we've kept interest rates at record low levels. In 2020, that was probably the greatest or the lowest interest rates in history. And of course, all the real estate markets around the world benefited from that. And you can see a rising trend. This is not Canada, it's pretty much all the advanced since 2012, and it peaked in the first quarter. And if you look at the numbers, we're entering a secular bear market in real estate, a very long term, probably a generation in real terms, maybe not nominal, but definitely in real terms, we're going to see prices down to sideways because the incomes aren't there. We've levitated with interest rates. I mean, everybody, uses supply and demand. Well, supply and demand can be affected by interest rates, can be affected by the demographics of an aging baby boom that has put in a huge supply in the market, mortgages, amortization, gross debt service ratios, and income. It's not just simple, we have all this immigrations, it will push up asset prices. It will not, because you have ridiculously high prices and interest rates as of today are hitting a new post-2020 high. The affordability will be at a record high. So high, the cure for high prices is high prices. And I believe that the current interest rate environment will just push real estate prices lower. And by the way, as I said, this model is really for baby boomers, and it applies to real estate. If you own it outright, that's a different story, and if it's your home. But if you're a speculator, I'd be in a position that I'd be liquidating as quickly as possible before we start to have a banking crisis. Okay, so now here's the problem. If we take a look at the private debt to GDP here, we can see it's not only beyond the 150% where we get into trouble, but we've surpassed Japan's private debt levels. And this is a warning. It's not a timing. And the reason why it's important, I marked that point there of stagnant incomes in 1984. That's real incomes. So you can see most of this private debt has gone into real estate. And that's why I call this Ponzi finance, is that most of the run-up in real estate is come from a leveraging upon leveraging. That's what Ponzi finance is. And once it reverses, it kills the confidence in that, and then the cycle starts to unwind. So that's a warning. Peter Kundal used to always say, market valuations are a measurement of risk, not timing, because bubbles can go larger. But the same thing with real estate. I understand people have warned for years, but it was obvious central banks and governments were going to kick the can down the road as far as they could. And the road ended in Canada, ends between 2022 and 2024 when the millennials who have cash, who are saved up for homes, are or will have been able to buy. It does not mean that they have bought, but basically we can see that the supply demand is behind us. Now, confirmation that the global economy is slowing. This is just Canadian exports, and this is in logarithmic scale. So you see, I just put a green line there, and those orange vertical lines are just peaks in the economy, right? October 90, January 2001, 2008. Notice it peaked in 2008. That's why we never had a real estate bust then, because it happened after the global economy was turning down. You can see the economy was already turning down before COVID-19. Its collapse and its rise. And you can see the economy in terms of exports peaked last year. That's a year ago, and it's still slowing. And that's another warning sign, again, why we're in a position of a high cash position. If you look at the yield spread, I call this the extreme yield spread. Anytime it's gone above zero, eventually, and it starts to collapse, then the recession is upon us. So you can see 2007, and late 2019. And here we're at an extreme level. So all the warnings are there. And you can see, again, if you understand what we're doing here, is to avoid losses in the portfolio. Real estate being number one, and number two is, of course, the markets. And we can see that with the TSX being weak, and the banks and the financial sector being extremely weak. So we're looking at the business cycle. Now, a warning that we haven't seen in history is M1, and you can see here the latest numbers, April 1st, it's actually contracting. And I believe the reason for that is just the credit is contracting like any great bubble that starts to deleverage. And it's a warning sign. And the only times you've seen that was in 1990 in Japan and the early 1930s. Interesting enough, this is happening globally. So it's not just, I don't want to show you every country, but take a look at the euro. And you can see the euro is going into a hard landing. Again, it's just a measurement of liquidity moving into the system. And you can see that once it breaks those that green line from left to right, then a contraction is on its way. It doesn't say how much, but basically it's just a warning, and that has of yet to reverse. So you can see that Europe had severe 4, 5, 6 years from 2008 to 2014. They had 2 recessions, and they're going into another one, probably leading the world. So U.S., you can see the U.S. is heading lower, Canada. Now, I've said that this is the advantage of studying long waves, and this is why most forecasters are wrong when it comes to interest rates. We have a secular rise in interest rates. The low for interest rates are over. Rates might collapse, but they'll head higher for a lot of reasons in default, and I'll get into that into the future as the economy unfolds. But this is a sovereign debt crisis. Now, I use the 5-year yield simply because this is where most mortgages are. Now, in blue is Canada, and in yellow is Greece. Notice just after 2007, it started to diverge, and then we saw interest rates go from about 3 to 4%, and at its peak it was 65. Now, that other peak there in 2010 was 15%. Can you imagine what that would do to real estate? Right? And we just have to go from, at the current yield, 4% on the 5-year to 6%, 10%, 12%. I'm not suggesting we're going to go 65, but 15 to 20 in a sovereign debt crisis. And that is coming, and I'll explain in the future why. It's inevitable. We're headed for a sovereign debt crisis because simply governments made too many promises. They can't keep it. They've indebted themselves. But it won't happen until after the real estate crisis and the banking crisis. And that will be the end for real estate because it's such a leveraged asset. And everybody says, well, you can't let that happen, won't let that happen. The market dictates. The market's too big. If people feel that the government will default on their debt, interest rates will skyrocket. To think that the Kondratieff cycle, as I call it, which is reflective of society, can be stopped is laughable. There are a lot of people who studied long waves, and they, were saying, well, they're wrong, they were wrong. A lot of them were looking for a turn 20 years ago, and I know that group. And the reason why it didn't happen is obviously it was this long-term mortgages, and they kept inflating the bubble. So that's why we have this record private debt that is not sustainable. And eventually it will collapse. They've just made it worse. Now we don't have an interest rate cushion because we were levered from the zero bounds. And that's in most of the developed world. And governments are already indebted. Unlike the 1930s or the 1920s, governments were paying down debt after World War I. They were fiscally responsible. So it was easy for the government to step in. And they were such a small part of the economy. They're such a large part that they only know to keep on expanding. And after we went off the Bretton Woods system, it was the era of spendthrift governments, and most of the public doesn't understand that. But, you can't stop Mother Nature or these cycles from occurring. And that's the problem we have today. We just have a unsustainable, unproductive debt, not create enough wealth to sustain the asset bubble. Does that make sense? Okay, so what I wanted to, and this is not part of the subscription service, but I want to just educate. I just look at models, and again, I designed this for myself. It never was meant to design or whatever, to be public. It just was my friends were like, Joseph, you need to go live with your discovery, be making great calls. Because I stepped away from the investment business 10 years ago, and I had health concerns and my own personal issues, but I always wanted to get back because I just have a love of how things work, right? That's what drives me, how things work. And a lot of people have already benefited from it. So I said, why not bring it forward? But I'm bringing it forward for a most important reason. That is, the website that I've launched is really to provide a satellite view of what's coming, but also to help businesses of the future. So I'm excited about that. And by the way, that's Kondratieff, and that quote by the Kondratieff was actually by Schumpeter. So basically, it's alluded to that what is occurring and has occurred. It's simply because of his discovery of this evolutionary capitalist system. And he suggested to Stalin that, the capitalist system is going to collapse, which he liked, but it was going to come back stronger. And of course, he didn't like it, and he was sent to Siberia, and later it was shot and killed, simply for suggesting evolutionary theory. And that's why, since Schumpeter and a lot of other people, we've always given a tip of the hat to him because of his discovery of cycles. And we've come to understand his theory will always be right because there's cycles in everything. So there's other theories of how things work. The economic long wave, and there's the Seculum cycle, Armstrong civilization cycle, Elliott wave, different theories of cycles which integrate human cycles or social cycles. And that's why I don't believe it's a theory. I think it's actually a reflection of how things work, but I have to articulate it's a theory. And why, again, we have a picture of him. That's not me, of course. Okay, now, if you want to go into a deep dive, I do have on the website Decoding the Long Wave. It's a comprehensive explanation. And I'm going to simplify that over time, but I try to educate the public how it does work. If you want to know more of my story, how I fell into this, there's also videos there. If you want to understand a lot more about the long wave, there's the books on recommended reading, from Kondratieff's early work to Schumpeter's business cycles, and a friend I met, Michael Alexander, the Kondratieff cycle. It's a very technical book, but I have to acknowledge Michael's really the first time I've heard somebody talk about the monetary wave, which is the theory is that the falling price of credit causes the levitation of asset inflation because the banking sector is able to leverage their product, which is credit, which causes asset bubbles. And so I can't say I came up with the monetary wave, but and these are the books that lays the foundation for a lot what I do. Mike Alexander's book is very technical and deep, but I'm sure it's going to satisfy most people who are curious how this works and what I understand. Now, if you want to contact me, there is a form there. And the reason for that is I do have a mastermind group. I'm actually having a first go of this on Saturday. And that's really to work with individuals who want to employ the Kondratieff cycle in their businesses. That is, I'll give them a roadmap. Not articulate what to do, but so we can avoid losses, know how hard the recession is. And over this next, from 2000, well, let's say from 2024 to 2040, this will be economic winter and markets will be volatile, adjusting, creative destruction, political revolutions, war, market collapses, all these massive changes will be occurring, and it's just to help guide people, and those businesses have an exponential chance of being very successful. And the last one here, which you're going to see, is the Substack account, where you can subscribe If you become a paid subscriber, you have access to the model, and I'll be updating that at least once a week, once a month, the latest, unless something changes. If something happens right away, I'll be here in the recording studio to update what is going on. But for the most of the Substack account, it's all free, so you could be educated on the information of understanding the long wave, parts of the business cycle, and so forth. Okay, if you have any questions, just let me know either in the Substack, or you can contact me directly and I can explain it further. Because what I'm planning to do as I make more changes moving forward as economic winter arrives is ways to inform and simplify the model, which is hard. I've done that on Spaces with Joe, if you're a listener, in that to simplify economics, especially the long wave, is challenging. But I do that with charts so you can see I'm not guessing. I don't have an opinion. I look at data historically, what has happened, what is occurring, and what are the indicators that are pointing toward a direction of an improving or worsening economy. And I do look at the social aspect, the political cycle, and technology. That part is actually exciting because the technology cycle will be driving the next upwave. And that's exciting because patent growth is going through the roof. Anyways, I hope that's in a simple way of understanding of the model for subscribers themselves, the paid subscribers to Substack. The models are pretty self-explanatory, and it has an allocation, and basically is, again, the purpose is to preserve your capital. It's wealth management. What I've seen in wealth management over the years and what it's developed into is just a diversified product. It's not wealth management. Wealth management, first of all, is that you're protecting your assets. And then if you're investing, you're being prudent. If you're a venture fund, which I've got no problem of, that are feeding these disruptive technologies, then there's enormous risk. We know most of them will fail, and they will, one or two will do well, and then society will benefit. But this is for your savings. And that is that you're wanting to protect it, whether it's $10,000 or whether it's $1 billion. You don't want to be overpaying for assets or holding on to assets overpaid. I mean, you don't do that with what your purchase is. I don't know anybody doesn't like a bargain. But for some reason, when it comes to investing, that goes out the door. When I started back in the I started in '89, but at the time it just made sense. Lucky I found Templeton and asked him, his philosophy, how to invest. And it just, you buy low, you sell high, and that makes sense. Whatever was hot, you'd exit and allocate to where it wasn't hot. And you avoided downturns, you made a lot of money. Surprisingly, most people don't invest that way. But anyways, so I'm rambling now, and I want to keep it to a half an hour. I hope that kind of simplifies it. By the way, because this will be a general audience, I will be starting next week with short videos. I'm going to keep them to 10, 15 minutes and just little blurbs. Tweeting and writing things on Substack is challenging, but if I can articulate what's happened currently, it's a small education and to what is occurring, right? Because we're going to be going through a disruptive change similar to 1873 to 1896 and 1929 to 1946. Unfortunately, we can't do anything about it, right? Apparently society has not learned from the past. Politicians and central banks and governments believe that they can thwart social cycles, which is laughable. Even Klaus Schwab, basically he wants this outcome. The public won't accept it. They want freedom. And what are the Kondratieff's fifth wave technologies? Freedom enabling technologies, empowering the individual. So why would they want to live under an authoritarian type of regime. This is going to be interesting. Now, I'm kind of smiling about it because you got to keep it light on a serious subject, but I've never believed and know that Saudi will never accept it. There'll be overthrow of governments. So anyways, keep up to that. Keep up informed. Watch for YouTube videos, short ones to the point, and I'll talk about everything from the cycle, real estate, which is the topic everybody's interested in, the political cycle, that's going to be going through a massive change in the next 1 or 2 years. Technological change, massively changing, artificial intelligence, renewable energy. I'm not against it, by the way. It just, CO2 is a pollutant. I can't take that seriously. Like seriously, to like CO2 is a pollutant. I hear both sides, and if you really look at history, they corrupted science. It's going to end badly for the West if we don't get back to real science. But I will acknowledge it's a growth industry because its price performance cost to the end user is plummeting, which will impact society, right? 3D printing, artificial intelligence, robotics. I mean, wow, the future is great. It's just getting through the next decade. Okay, I've rambled enough, and we'll talk soon, and hopefully this helped a little bit in understanding of the long wave and the model, the most important aspect. We'll talk soon. Thanks.